Try the following example on your own. Sally needs to borrow $12,000 to purchase a car and determines that she can afford monthly payments of $300 based upon her current budget. The banks offer Sally three different choices: a 3-year loan at 7% APR, a 4-year loan at 7.5%, or a 5-year loan at 8% interest. Which loan best meets Sally's needs? To help you decide which is the better option, considering the following questions. Which loan can you afford the monthly payment on? Which loan option is best to pay less over the course of the loan? Pause the video here and try this example on your own before moving to the solution on the next slide. Let's take a look at option 1. Sally was offered a loan for 3 years at 7% annual percentage rate. Once again, we're going to use the time value of money application, or the TVM solver, to figure out what our monthly payment turns out to be. Since we are going to be making monthly payments over the course of 3 years, there's going to be 36 times that interest is going to be calculated. Our annual percentage rate is 7%. The present value, or what Sally had to borrow in order to purchase the car, was $12,000. So that's the loan principal, or the present value of the loan. We don't know what the reoccurring payment turns out to be. Be careful. We know that she budgeted $300. We don't know that that's what she's going to spend. She could spend all of it or just a portion of that. So we don't know what the payment is going to be in this option. That's what we're looking to solve for. Remember, the future value of any installment loan is always going to be 0 because we're trying to pay back that loan, pay it down to 0. PY and CY, once again, because we're making monthly payments, it's going to be 12. Slide the cursor back up to the PMT quantity and solve. And we see that Sally's monthly payment would be approximately $370.53. Unfortunately, Sally cannot meet this monthly payment based upon her current financial situation. Recall, she can only afford a $300 car payment. Let's take a look at the next option. In the second option, we had a loan term of 4 years at an annual percentage rate of 7.5%. We're going to use the TVM solver. Again, notice most of the values remain the same. Right? The only difference is the loan term and the annual percentage rate. So since we are making monthly payments over the course of 4 years, 4 times 12 gives me a total of 48 compounds, or 48 times that interest is going to be calculated. The interest rate is 7.5%. The present value, or the loan principal, is the same, $12,000. Again, we're looking to calculate her monthly payment. Future value still going to be 0. We're still making monthly payments, so PY and CY are 12. Slide the cursor back up to PMT in order to solve. And we see that Sally's monthly payment would be approximately $290.15. Let's take a look at the third option. In the third option, the bank gives us 5 years to repay the loan, but charges an annual percentage rate of 8%. Setting up the TVM solver, again, since we're making monthly payments over the course of 5 years, 12 times 5 gives me 60 times that interest is going to be calculated, or 60 compounds of interest. The annual percentage rate is 8%. Present value remains the same. She's still borrowing the same amount, $12,000 for this car. Payment we're looking to figure out. Future value of any installment loan calculation is always going to be 0. Remember, we're always trying to pay down the balance of this account. PY and CY are 12, just like in the previous examples. Slide the cursor back up to PMT in order to solve. And we see that Sally's monthly payment would be approximately $243.32. Sally can only afford the second or third option, but which one is best? Certainly it would be nice to pay less each month, i.e. the third option's monthly payment is almost $50 cheaper, and that means Sally can spend that $50 elsewhere, probably on gas. But is that the best decision? When determining which option is better in a loan scenario, not only must we consider the short-term payment, but also how much the loan is going to cost us in total in the long term. By setting up a simple unit conversion, we can see how much Sally's $12,000 car is actually going to cost us. In the second option, Sally was paying $290.15 per month over the course of 12 months for 4 years. So in total, that loan is going to cost her $13,927.20. In the third option, Sally was spending $243.32 per month over the course of 12 months over the course of 5 years, meaning in total we see that Sally's $12,000 car in the third option costs her $14,599.20. The lower monthly payment was offset by the additional year of the loan and actually ended up costing her more over the course of the loan term. There will always be some trade-off between low periodic payments and a higher cost of the loan. The question becomes, what type of financial situation is best in your case? Are you worried about the balance of your account on a monthly basis? If so, you probably want a low periodic payment to ensure other bills are satisfied. If you have a steady job and are comfortable in your finances, you probably want to spend the least amount possible for the vehicle, so you would opt to spend a little bit more on the periodic or monthly payment to save in the long term over the course of the entire loan.